Some IUL policies earned 158% in 1 year. In this episode, I'm going to explain how you can earn 2.7 times what the market does using multipliers. Get ready. A lot of financial planners and especially insurance agents do not understand this. So my name's Doug Andrew, and I've been helping people optimize their financial assets for more than 47 years. And if you've watched very many of my YouTube videos, they're educational, and one of my favorite vehicles for people saving for long-term goals like retirement is a maximum funded indexed universal life insurance policy. This is where for a 25-year period, I was able to earn average returns of 11.17%, netting cash on cash 10.07%, meaning, golly, if you're earning 10%, your money will double every 7.2 years. Every million you end up accumulating at retirement when you start taking income can generate $100,000 a year of tax-free income into perpetuity if you live to be 120. This has been true for many, many people who have properly structured and maximum funded indexed universal life policies. Now, a lot of times when people learn about indexed universal life, IUL, they watch some of my educational videos on this very channel, and they understand, okay, so Mr. Andrew has helped many people earn average returns of 7, 8, 9, 10%, some years higher, some years lower, using the indexing strategies. So let me start out and explain the basics of linking to an index of your choice with maybe a 1-year point-to-point, a 2-year point-to-point, or a 5-year point-to-point. But here's where multipliers can dramatically increase your rate of return. You ready? So when you have an indexed universal life policy, and let's say you've accumulated $1 million of cash value in there, and we have many clients that have way more than that, less than that, but you can extrapolate from $1 million, okay? So let's say you have $1 million of cash value and you feel bullish about America at this point in time, and so you tell the insurance company, link. What you're doing is you're giving up the for sure general account portfolio interest rate that the insurance company is earning on their portfolio of assets. So back in the 1980s, I was earning 11.75% to 15.5% on the general account portfolio. But as interest rates came down in the 90s and the early 2000s, indexing was introduced in 1997 because the general account portfolio rate of insurance companies ended up being around 4, 5, or 6%. If they were earning 6, they needed one of those percentage points for their profit, and I would net 5. If they're earning 5 and netting 4, they would pay me 4 right now, let's say. So that means on $1 million, if I feel like, ooh, we're headed for a recession, I can just hunker down and settle for 4%, which is way more than banks are paying. They pay less than 1%. So on my million, they would pay me $40,000, and it's tax-free. So I can do that if I want. But if I feel bullish about America, I can opt to link. I could go link on July 15th or November 15th, or I could say link and they can take 1/12 of my million and link it July to July, August to August, September to September, October to October. That's called dollar cost averaging. And what they do is they say, how do you want to link? What strategy? Now, the most common is an annual point-to-point. So that means if I link in July on the 15th, I wait until July of the next year, and then they measure if the S&P grew. If it grew 10%, if it was 1,000 when I started and it's 1,100, that's 10%. On my million, they must pay me 100,000. Now, the key to indexing is my million has to stay safe in the insurance company. So if the economy or the market crashes, I don't lose. So how can they afford to pay me if my money's not in the market? It's because I gave them the interest, the 4%, the 40,000. They used that to buy upside options or to fund an options budget, and they buy upside options in, let's say, the S&P, if that's the one I chose. So if the S&P goes up 10, that 40,000 gives them the ability to pay me 100,000. It's how options work. Now, in other videos, I explained that They can cap you at 10.5%, or you can say, you know what? I want a 1 year point to point with no cap. So then they'll pay me whatever the S&P does if it grows to 20 or 30 or 40%, but they may subtract 5% or 10%. That's called a threshold spread. And so if the market went up 30 or 40, instead of paying me 40, they pay me 30 because they may subtract 10%. Now, you can do that with no cap, and many people did that from March of 2020 when the market crashed during the COVID-19 pandemic. My sons told their clients, okay, Link used the 1 year point to point with no cap. And a year later, they were able to see 66.33% increase, but they subtracted 5%. The threshold was a 5% charge. They netted 61.33%. We had clients that had $872,000 in his policy. He ended up with $1,370,000 1 year later. Made over $500,000 in 1 year. 61.33%. I want you to remember that because I'm going to teach you about multipliers now. What is a multiplier? Now, when you say link to an index, most of the time the insurance company is only using the portion of your general account portfolio that makes sure that if the market crashes, you will still have your principal of, let's say, $1 million in this example at the end of the year. So zero's your hero, you didn't lose. So they only use as much money as they can afford for the options budget to be able to do that. But, sometimes people go, well, you know what? I want to go for it. What if I gave you authorization to use 7.5% more of my million? Well, if the market goes down, you would lose 7.5% of $1 million. You'd lose 75,000. Well, yeah, but the upside is much greater. That's better than if the market crashes 40%. I would lose 40%. My million would go down to 600,000. I'm willing to take a risk of losing maybe 7.5% if the market tanks. Are you understanding this? So if you tell the insurance company, okay, in addition to the interest on my million buying options, I'm going to let you take another 7.5% of my million to buy options because I can handle a 7.5% loss, but not a 40% loss. But the trade-off is the insurance company now goes, okay, we'll pay you 2.7 times whatever the S&P does. So we had clients that earned 61.33% times 2.7. Do the math. They got over 150% rate of return by using a multiplier. So let me summarize this. When you have IUL using multipliers, they might charge you 7.5% fee. On $1 million, that's $75,000. But that's the most you're going to lose, and that funds the options budget with more money than just the 4% or the $40,000. Now they have 4 plus 7.5, they have what? 11.5% to buy options. And they will pay you 2.7 times whatever the S&P does. If the S&P goes up 10, they'll actually pay you 27%. It costs you 7.5, you take that off, and you actually netted 19.5. That's usually what happens, but my heavens, those people who did it from March of 2020 to March of 2021, 61.33% times 2.7, it was unbelievable. The rate of return was 158% for those people using the multiplier. Now, sometimes people say, I don't want to give up 7.5%. So they say, how about 5%? I don't want to lose any more than 5%, but I'm willing to do that. If you do that, they'll pay you 2.14 times in this particular company. So if you earn 10, they'll pay you 21.4 and they'll subtract 5%. And this is a lower fee, but it's a lower multiplier. But this is where the insurance company will buy more options to fund their options budget. So what does this mean when you look at averages historically? Because some people say, this is incredible. Now, sometimes these are called performance factors, but most of the time we call these multipliers. So the 40-year historical average returns, if you had multipliers, if they were available clear back then through the last 40 years, without a multiplier, you just had your money in the market, your return would have been 6.9%. By using multipliers, okay, it went up to 10.8%. So you're able to tweak the rate of return based upon historical averages from a 6.9 average up to a 10.8. It may be worth considering a multiplier on some of your money if you own an IUL. If you don't own an IUL, you ought to look into it to be able to earn those kinds of rates of return tax-free. That is net of the multiplier fee. Okay. The returns are approximate here based upon 40 years of history, depending upon when you linked and so forth, but that's the average. So finally, let me show you a 40-year historical average return. This is 100% participation. And I'm going to use a 5-year index strategy, which I explain in other videos, but this is where you wait 5 years to see what your returns are going to be, and also a 2-year index strategy to see the difference. Without a multiplier using the 5-year, you would have averaged 9.04%. And that's why many times we advise clients to put in 40%, maybe 20% of their allocation of their cash values in their policy to a 5-year strategy. A 2-year strategy is 6.6, and you go, well, golly, this looks pretty good, 9%. With a 5-year, with a multiplier, this one goes to 16.24% because you're getting 2.7 times that, or you're getting 2.14 times that. This one moves from 6.6 to 11.96. This is net of the multiplier fee based on index strategy allocation. 100% 5-year point-to-point last year average. I explained that in another episode. With no cap and 110% participation rate. The 2-year is 100% participation rate with a 19% cap. So multipliers can dramatically enhance your rate of return. You're willing to give up a little bit more of your money if the market goes down. Instead of 0 being your hero, maybe you're willing to lose 5 or 7.5% if the market crashes 40, but you don't lose 40. But if the market goes up, you get 2.7 times whatever the S&P grew by. That's pretty incredible. That's called a multiplier, and I would strongly recommend that you look at those, and not all companies offer these. But what does it mean? This is an actual statement of the client that started out with $872,786 in March of the year 2020. He chose to link to the 1-year point-to-point with no cap, and a year later, he actually earned 61.33%. He was thrilled. He made $500,000. He ended up with $1,387,000. But when we showed him, golly, if you would have used a multiplier, you would have made 158%. Now, 61% is not a bad return, making $500,000. But he I could have made 158%. Yeah, sometimes hindsight is better than foresight, right? But folks, the point is this. If you want to learn about these various strategies and how multipliers can work for you, you want to talk to an IUL specialist. But I would recommend you read this book. You go through an 18-hour masterclass if you really want to learn. So you go to laserfund.com. Now, I'm going to gift you a free copy of this 300-page book. You contribute a nominal amount towards the shipping and handling. And I will send out a copy of this book to you. It's 300 pages containing charts, graphs, explanations, plus 62 actual client stories when you flip the book over and read the right brain side. But this is to empower you, and then there's options there to listen and learn, watch and learn, and also you'll be notified whenever we teach educational webinars that are free for you to attend on various topics about asset optimization and tax minimization. So here's to your brighter future. Claim your free copy now.